Greetings, my name is Ted Hicks. I'm the founder, CEO, and Chief Investment Officer for Hicks & Associates Wealth Management. Today's Friday, September 23rd. It's about 2:30 in the afternoon when I'm recording this. And today's sell-off in the stock market is indeed retesting the lows from June, something we've been talking about as a distinct possibility for a while now. So just a quick update in terms of what we're seeing. On the screen right now is the S&P 500. Every line on this chart is the S&P 500 that dates back to 1976. The bold red line is the current year, and if you can hopefully tell that we are, as of yesterday, tied with the second worst year since 1976. Today's low will make this the second worst year since 1976. This maroon line is 2002. So at this point in the year, 2002 is the only year that was worse since 1976. So let's take a look at what's happening today. So on the screen right now is SPY. SPY is the ETF, or the exchange traded fund, that attempts to mirror the S&P 500. And you can see that today's candle is pretty negative, gapped down at the open, and it's been trading down all day. And it certainly looks like it is breaking this support. We might get a late hour rally, so the market will close above this support, but at the moment I have no confidence that that will happen, which brings me to the next point. So now on the screen we have the S&P 500 via a monthly candle chart. So every candle on the screen represents a month of trading in the broad index. So remember that the black candles, think of those as lead. Think of a lead weight, and think of the white candles as a white cloud or a white balloon or something like that. So white is rising, black is sinking. So this is the month of June. The month opened here at the top of this black bar, and it traded down to this black bar or black candle. Month of July comes around, and it has a very good month. All right, now what I really want to focus on is the months of August and September, and in particular I want to look at the wick, the top of these two candles. So again, as a refresher, what we're looking at when we look at these candles is the month opens at the top of this black candle, and because there's a wick here, what that means is the market traded up to the top of this wick. And you might recall that in the month of August, the S&P 500 actually kissed the 200-day moving average, but then the bears stepped in and pushed the market all the way back down to close the month of August at the lows for the month. Then September opens up. Remember, we've talked about September historically is the worst month in the calendar year. So the market opened here. The market traded up to the top of this wick. Again, the bears stepped in and have pushed the candle back down, and it looks like we're going to be closing at the lows for the month this Friday the 23rd. So what is important is that these tall wicks at the top of these black candles are indicating that the bears have far more control than obviously we would like to see. What's really a concern is we've been talking the last couple of months about the possibility of retesting these lows from June, and that's happening today. And so the good news is we are indeed retesting it. Sometimes we need that in order for a market to have a nice healthy rally. We got to test that low more than once. So to some extent that's good. The bad news is if we flip back to the S&P 500, it looks like we might actually close above this line. But if the market moves lower, there's not much more support here. Now, this is where we're going to talk about the averages. Now, this is off the top of my head, but generally speaking, a bear market that coincides with a recession is worse or longer than a bear market that without a recession. Again, we've been debating all year about whether or not we're in a recession. We've been discussing the fact that we believe we are in a recession. The first and second quarter GDP stats were indeed negative. Yes, they were barely negative, but they were negative. Third quarter GDP looks like it might be positive. The last estimate I saw is barely positive. But with Chairman Powell's comments as of late, he is suggesting that we are going to need below trend growth in order for inflation to be under control. Well, again, the trend is already negative. If you look at the GDP stats, therefore below trend would be even more negative. So it seems to me that Chairman Powell is suggesting that the economy is going to get worse. And so there would be less of a dispute as to whether or not we are in a recession, which tends to suggest that this bear market is not over anytime soon. Now, that doesn't mean, by the way, that the market can't have periods of rally like we saw in the month of July. So we need to be careful when we're talking like this, because I'm not trying to communicate that we should just all go to cash and just sit there and wait for everything to recover. That's not necessarily what I'm suggesting. But I am suggesting, as the data has pointed to today, that we are in a very difficult environment. However, perhaps next week I will show what happens the year after we have a bear market. But I think we've gone on long enough for today. If you have any questions, feel free to reach out to us. You do not need to be a client. Just reach out to us, hicks-associates.com. We thank you for watching. If there's anything we can do for you, please, by all means, reach out. Again, thanks for watching. If you like these videos, we do ask that you hit the like button on the YouTube channel and Facebook and whatnot. It does help the algorithms, and we appreciate it very much. Have a good weekend.